Hi, good morning, everyone. This is Paul here. Okay, good morning, everyone. This is Paul here. I will begin with the results for APTV. Okay. Okay. With regards to the first quarter 17 of APTV, you can see that the revenue and EBITDA was within expectations. It was up 6% year over year, driven by subscriber growth, and more importantly, there was a strengthening of the Taiwan dollar. The other positives were mainly there were lower interest rates. There will be occurring second half onwards from the new negotiations by the new trustee manager of APTV. As just to recap, the new owners of the new trustee managers of APTV are actually linked to the Honhai Group. Terry Koh actually has a 20% stake in the trustee of APTV. Just to going back to the results, what hurt the headline numbers, as you can see, the profit dropped almost 70%, but most of it were due to non-cash items, the FX, and also the more important was also the derivatives mark to market, as they actually hedged out their dividends. And the other major item was the deferred tax and also the amortization of interest arrangement fee for the loans. None of this affected our valuations or cash flow or our cash flow estimates. We still maintain a buy on APTV. The dividend per share per unit is 6.5 cents, and this is reaffirmed by management. At the current price of 595, this is around 11% yield. And more important is that these dividends are paid on a quarterly basis. Okay, the next step moving forward is do we actually raise our target price? To actually do so, we actually need to observe more initiatives by the trustee managers. We've already seen something positive, as mentioned earlier. They actually managed to lower the interest rates in second half by 30 basis points. So that's an immediate 4 million Sing savings, which is almost like 5% of dividend payout. But again, we need to see more before we actually move on our target price, which is 64 cents. Just to highlight and a reminder, when we looked at APTV results, the key operating metrics that we always look at, the first number that we look at is always the number of subscribers, the KBTV subscribers. And this quarter, it has been stable. And the next operating metrics that we always look at is the content cost. That's it for me on APTV. I will move on next to CNMC by Concha. Thank you.
Hi, it's Guanzi here. So last week, CNMC announced their first Q results. Again, this unfavorable quarter together with the last quarter it's underperformance disappointed the market, which it raised concerns. So we revised downward our target price to 44 cents compared with last 68 cents. Since last done price was 30.5 cents, we maintain our buy rating. So let's take a look at the financials. The revenue dropped by 44% to 4.7 million. This was due to around 50% drop in the sales volume due to the lower ore grade, and which was offset by the increase in ASP. And again, the operating profit was quite minimal due to last quarter's 5.6 million. This was due to substantial drop in unrealized FX gain. So the bottom line was in line with the drop in the top line. So you can see here the sales volume was 3.7 around 3.67 K ounces in first quarter, and the average sales price was 1,000 to around $1,287 per ounce. Because last year CNMC ramped up the capacity to 1.2 million tons of processing ores. So you can see here the table shows the production statistic of the current 2 peaks that the company is conducting mining activities. You can see here the calculated ore grade was actually trending down. However, we think that the new farm peak, you can see here since last year, the CNMC started to mine this peak, still have higher ore grade. So according to the management, they propose 2 solutions that may help the current underperformance. The first one is that they will establish the carbon enrich plant to ramp up capacity and raise recovery. And also they will probably started to mine the maintenance low peak, which have the reserve of silver, lead, and zinc. However, we think that it will take time to realize the profit from these 2 solutions. And also in first Q, CNMC acquired the third gold mine, Calgo, together with the previous Pulai project. We think that when these 2 mines commence operation, we think that the situation can be turned. So here we revise our forecast. You can see a table here. We revise downward the implied gold grade. This is the production weighted average ore grade. Since you can see here the current 2 mines of Rixon and New Farm. So this is the production weighted average cut-off grade of Rixon and New Farm. We think that if the ore grade drop below the cut-off grade, there is no point for the company to continue the mining activities. So this cut-off grade here, 31 gram, 0.31 gram per ton is the break-even ore grade for CNMC to continue the mining. So here we forecast the all-in cost for this year will continue to go up to $945 per ounces. And the next year it will slightly drop because we think that the gold price will increase a bit in this and next year.
Morning guys, it's Peter here. We have a results update on UOL Group. So results, they continue to deliver. In the first quarter of 2017, revenue was up 6% to $351 million. So it flowed through to its net income, which grew about 4% or so on its net income level, brought net income to around $80 million or so. So just 3 important points on the first quarter of 2017. So on a Singapore property development frontier, the group remains at a very comfortable state. So they in the previous quarter they had 4 development projects ongoing. 2 of them already fully sold. I'm referring to Riverbank at Fernvale and one more, which is Botanic, which is at the around the Serangoon region. So at this point of time, what's remaining on their hand is Principal Gardens, which is 55.4% sold, and Clement Canopy. So for Principal Gardens, the thing to take away from here is that from previous transactions, what we can infer from is that the average selling prices or ASP remains healthy. It's about $1,600 PSF to the plot ratio or so, and this maintains very well from so essentially there were minimal price cuts. So meaning to say that development margins are still within our expectations, and the RNAV estimates will remain for this development. Moving forward, at the point of publishing of my report, we expected competition to remains to actually kind of stiffen because of the new launches nearby, as well as the potential price cuts from nearby developments, which the developers were trying to cut prices in order to avoid the clawback of ABSDs. But if you followed the news last week, there was actually a record price tender at Stirling Road, which is around the Queenstown region. It came in at $1,050 per square feet. So this is the highest ever land price that was being tendered out within the region as of the within the it's a historical price. I mean, in other words. So how it will benefit UOL is definitely for Principal Gardens. Principal Gardens is selling around $1,600. So if you take like $1,050 of land price for Stirling Road's development, it means that you can expect selling prices to be around $1,800 or so. So pricing at $1,600 is definitely not high, and we expect the momentum to be boosted moving forward. That's for Principal Gardens. So next is Clement Canopy. Nothing new about it. It was launched in March 2017. So traction is strong, and we can expect the sales momentum to continue because of its proximity from 2 growing districts. One is One North, which is Buona Vista, and Jurong 2nd CBD, which is in Jurong itself. Now, for the recurring income segment, we're talking about the acquisition of this one hotel property. It's 396 room. It's located in Melbourne, Melbourne South Wharf. So UOL's intention is to rebrand this to Pan Pacific, and eventually, according to our projections, we expect the annual revenue from this hotel property to boost hotel operations revenue from the group by about 5% or so. And this will, in other words, will boost recurring income by about 2-3%. And finally, moving forward, the group is still on track to launch 3 new launches or 3 new development projects in 2018. 2 in Singapore and 1 in UK. I've talked about this in the previous quarter, so I will not bog you guys down on the details. But nonetheless, the thing to take away from here is that these 3 new development projects is expected to boost our RNAV estimates by about 9 cents when completely sold. So this is all for UOL. I'll pass the time to Lin Sim to talk about Singapore ONG.
Thank you, Peter.
Guys, I'm sorry about it. I think the most important thing is to tell people about about the call. So we maintain a accumulate call. Target price is $7.64. The last price as for yesterday was on Friday was $6.86. So yes, that will be for you.
Okay. Thank you, Peter. So let's move on to Singapore ONG. As the title mentioned, that we continue to see ONG, the Singapore ONG, particularly their core business segment, the ONG segment, continue to gain market share in their first quarter. If we compare year-on-year basis, so we see number of deliveries grew about 10% year-on-year, vis-a-vis a slight dip in the total number of live births in Singapore. The management contribute to the slower number of deliveries in the first quarter this year and the last quarter, the fourth quarter of 2016, due to the negative sentiment arising from the Zika virus. So we continue to remain positive, and management mentioned that they are cautiously optimistic that the numbers would recover later by the end of the year, but we will continue to monitor the trend. Nonetheless, we are still upbeat about the ONG segment, given that they have a new recruitment, as we seen last year in the mid of July, with Dr. Hong joining the Singapore ONG segment. And we also continue to see a positive gain of market share in this current segment. And nonetheless, the management also guided that the first quarter, although that it met our expectation, but it is at the lower end, where because this first quarter is seasonally the slowest quarter of the year. So moving on to our second point, on the EBIT margin, factor, where we see that there's a slight dip of 1.6 percentage point. This is mainly due to the higher operating expenses, where they have a higher rental expense for the two new specialists joined. One, as I mentioned earlier, Dr. Hong from the ONG segment, and the other one would be on the cancer-related segment, Dr. Lim. So they have new clinics for each of these doctors, hence higher rental expenses. And we also see a higher depreciation cost coming from the new 4 ultrasound machine bought during the year. And hence we see some pressure on the EBIT margin in the first quarter. Moving forward, we will be expecting that the new pediatric pillar could also put some pressure against the EBIT margin, but this should be partially offset by the cancer-related business, as we expect that Dr. Lim, who just joined last year, would turn profitable by end of the year, hence bringing up the whole profitability of cancer-related business to a higher level. Last but not least, the main key takeaway for this first quarter's results would be that SOG has finally officially announced their new addition pillar, the pediatric services, which they target to commence operations on 1st of July. So this essentially capture the whole ecosystem from the birth of a baby and moving on to their adolescents and teenager segment, where they contribute on the pediatric services. Then moving on, it will be on the women-related services in ONG. So this basically completes the whole ecosystem. So with this, we expect that SOG is going to start with one consultant first, with one clinic located in the Park East Hospital. Essentially, it will be close to its ONG specialists. To just elaborate on this ONG specialist located in Park East Hospital will be Dr. Heng and as well as Dr. Natalie Chua, who are the top gross ONG specialists within the group itself. Hence, we think that this is actually a very strategic location for their first pediatric consultant. So with this, when we are positive about these new pillars, given that it can immediately tap onto the established base of about 7,000 babies, which SOG has delivered over the past 5 years. And the existing 6 ONG specialists should be able to provide a sustainable potential patient pool to this new pillar as well. So these are the few potential re-rating catalysts. New recruits of medical practitioner for it to expand the current 3 growth pillars, namely the ONG segment, the cancer-related segment, as well as the dermatology. Secondly, it will be on the new product development or successful marketing of existing products to drive greater profitability for its derma segment. So the group, the management has actually mentioned that they have identified about 4 to 5 products, which is within their existing range of skincare products, which are suitable for pregnant women to use. So they are currently marketing this range of products in the clinics. Thirdly, it will be a better than expected margin improvement, particularly its cancer-related segment. As you are aware, the cancer-related segment has just turned profitable last year, and currently is being dragged by the new recruit, Dr. Lim. So with our expectation that it should be able to turn profitable by end of the year, it should be able to lift the EBITDA margin of cancer-related segment. Fourth, faster than expected time to reach profitability for its new growth pillar, because at the moment we do not have any information on what are the pricing power and so on. Hence, we have yet to change our assumption. Last but not least, expansion into complementary medical services, which the management has mentioned before, such as IVF to complement its ONG segment. So with all this, we have maintained our target price at 79 cents. This is actually a $1.50 pre-stock split. So we maintain at 79 cents. That's post-stock split price. And we downgraded to accumulate price due to the recent price run up, because at the point when we wrote the report, it was at about 70 cents, but the price came down a bit. It's at 67 cents. 67 cents last Friday. Yeah. Nonetheless, we maintain an accumulative call. And with that, I would like to pass on the presentation to Jeremy, who will talk about Centurion.
Hello, good morning. My name is Jeremy. So here's the Centurion results. Okay, so the year-on-year 26% up is what everybody would have known. They had the 4 UK assets. So what is more remarkable is actually the quarter-on-quarter growth, because of 2 things. One is the improved rental rates with the student accommodation business, and the other one is the better occupancy at Woodlands and Papan, which is the Singapore worker dormitory business. So the more remarkable thing on this quarter-on-quarter growth is from the Singapore side of the business is that the rates have consistently been on the higher side, and so every unit increase in occupancy actually amplifies on the revenue line, which gave that significant boost. So let me bring back to what has happened in the last 2 quarters is that there was some views on the bed rate competition, and there was a fear that the rates could have come down. But clearly after 2 quarters, that's not the case for Centurion. They have continued to maintain the bid rate at about $290 per bid per month, which is higher than the competitors at about $250 per month. So despite not cutting prices, they have actually managed to improve the occupancy ahead of our expectations. So this is actually a very positive development. And moving ahead, we see that the favorable supply and demand dynamics would help support this, support the business for them. And given their value proposition in the market, we believe they will be able to maintain that pricing power for this year. So the next thing would be on the cost of sales. So you can see that on a quarter-on-quarter basis, there was also an increase in cost of sales in line with the increase in revenue. This was a little bit different from our expectation because we expect the model for Centurion to have a high operating leverage. So which means that whenever they increase the revenue through raising rates, for example, or maybe marginally raising the occupancy, we should not see that proportionate increase in operating expenses and cost of sales. So the additional 5% we see here is actually mainly because of the higher property tax from the higher valuation from Esprit Westlight, Papan and the RMIT Village. This is considered a bit lumpier and seasonal. So moving forward, we will still expect the advantages to the operating leverage to filter down to Centurion's results. So that's it from me. So next will be from Del, who will talk about Croesus Retail Trust.
Okay, morning guys, Del here. Croatia's the third quarter results last week. So revenue went up 22%, and this was primarily due to the two newly acquired malls they did last year. And there was also higher variable rent and tenant reversions. So you saw that year on year 3Q revenue went up 22%. But if you go down the line further, distributable income actually went up a higher 25%. And this was because of the savings that they achieved in the lines after the gross profit. So there were many aspects of this savings that they achieved, and I'll touch on them later on. So year-to-date 3Q DPU was within our expectations at 76% of our full-year forecast. So as the title of my report goes, multiple drivers of growth for FY17 and 18. So I will now touch on what are some of these growth drivers that investors can expect from the trust. So firstly, in the quarter, management actually hedged their Sing Dollar Jap Yen rate at 72.72 for FY 2019's distribution. So typically management will hedge the Sing Dollar Jap Yen exchange rate outwards by 2 to 3 years. So for now, from FY17 until 19, all the distributions are hedged, and 72.72 is actually a very favorable rate because right now the rate is actually doing at 80, around 80. So just from this favorable hedging rate alone, you're going to get DPU growth in FY18 and 19 by 8.6% if in FY18 and 4.8% in FY19. So this is assuming all else remains status quo. Rental revenues flat, everything doesn't change. Just by your hedging rate alone, you're going to get that kind of growth. And to add on to this hedging rate growth, you also get lower refinancing costs that the management achieved from the debt that they refinanced this year. And then we know that last year CRT also internalized the trustee manager. So you can expect lower trustee manager fees from the internalization. So all in, you see that the the lower interest costs that they are getting on their new debt, and then this lower trustee manager fees for this year, it is going to add up to about 10% of our forecasted FY17 distributable income. So you see multi-prongs, multi-pillars of growth for CRT going forward. And okay, so recently there was an announcement about a potential offer for CRT, and the negotiations are still in the works. So even after the rally, we do not think that the price is expensive. So from a portfolio perspective, you see that from IPO in 2013 for CRT, because of the loose monetary policies in Japan, the portfolio has been continually revalued upwards, cap rates have been compressing, and so from 2013's valuation until now, if you ignore whatever gains that they have had before the IPO, from 2013 until now, you see that the portfolio has actually been sitting on a revalued gain of 18% since IPO from 2013 until now. So 18% increase for the past 4 years. We expect this compression in cap rates to continue in Japan because firstly, monetary policies there remain loose, and then you see that the government is actually pretty persistent and determined to kickstart the economy. You see that on top of the loose monetary policies, they have been slowly opening up the country to foreigners. They've been trying to improve the labor force growth rate, getting more women to come out to work. So all this I think bode well for the Japanese economy, and which is why I think the cap rates compression will continue. And one more point to note is that on top of the cost savings that I have mentioned, one other potential cost savings for CRT could be that in FY18, they have a chunk of debt expiring that is close to 50% of all the debt they have. And this is a pre-IPO debt that they have already taken up since the pre-IPO, and this debt has been pegged to the Jap Yen LIBOR, and we see that the Jap Yen LIBOR has been falling since 2013 until now. It was doing about 0.5%, now it's only about 0.2%. So when the time comes for refinancing next year, you can expect further savings from them as well. So all in, we maintain our accumulate call. Our target price is raised to 1.08 after factoring in the exchange rate that management has hedged for FY19. So after factoring in the 72.72 in FY19, you have an upwardly revised target price of 1.08 from 93 cents previously. So with that, I pass on to Richard for the remaining 3 results.
Hi, good morning. This is Richard speaking. So first on Namly Press Metal, we maintain our buy, target price unchanged, 52 cents. We are forecasting same dividend for this FY, 2 cents. That will give you about a 5.4% yield based on the last close price of 37 cents last Friday. So we'll look at the results now. Year on year for the first half year, revenue was lower due to the aluminium segment, which had a significantly lower revenue in 2Q17. Here you can see that gross profit is lower year on year, about 27%. This resulted in a lower gross margin of about 19% from about 24.5 in the last year. This was due to a change in product mix and higher material cost. However, the higher material cost is offset in a derivative gain in the other income line. So as a result, actually PATMI margin remains quite stable year on year after the offsetting effect of the derivative. So for PATMI now is ahead. It has met 53% of our full year forecast, and we are keeping our full year forecast. The reason for that is because of the lumpy nature of the revenue for the business. So we're not raising our expectation for FY17. Okay, here I've already mentioned this lower gross margin, and net margin has been stable. So this first half year was 8.1% versus 8.6% in the last year. On the balance sheet side of things, they have collected a significant amount of their trade receivables, and they've halved that account. So quarter on quarter, receivables has halved from 44 million to about 23 million. Their 3-year average for the last 3 financial years was 34 million receivables on the balance sheet. And as a consequence of collecting the receivables, cash also has increased by about 7 million. Quarter on quarter, it has increased from about 35 to 42 million. The 3-year average is 40 million or so. All in all, the Namly has a clean balance sheet with a cash hoard. The net cash position is at 15.9 cents per share, and it represents about 44% of its market capitalization. Debt to equity also is low, so they don't use much leverage, and it's the ratio is at 2.6%. So because of that, large cash and little debt, they're actually earning net interest income. Current asset value per share is 35.8 cents. That compares close to the current, the last close price of 37 cents. Next is on SATs. SATs will maintain neutral with a higher target price of 508. Previous was 473. We are forecasting a flat dividend for the new FY18 that ends in March. The forecast is for 17 cents, same as FY16 which just ended. 17 cents would be about 3.3% yield based on the last close price. So we'll go into detail on the results first. For Food Solutions, revenue grew 0.6%. This was due to the effect of the deconsolidation of their lower margin food distribution business to their joint venture. So they had this food distribution business under SFI, and that was taken out. To contribute to their joint venture with BRF, and that joint venture is SATS BRF Food. Overall, at the group level, revenue has been up 1.8% year on year. The revenue would have increased by 4.5% if not for the deconsolidation. So what this means is that actually there has been organic growth for SATS overall. EBIT margin year on year also improved, but that is because of that deconsolidation. As I said just now, this food distribution business is a lower margin business compared to the aggregate. And then you see here associates and JV higher by 36% year on year, but this is mainly due to a one-off effect. So what happened is that SATS had added on to their stake in Evergreen Sky Catering Corporation. From 15% they added on another 10%, and so now that entity is has been shifted from a long-term investment to an associate, and during that change in recognition of that investment to an associate, SATS had recognized a negative 15 million goodwill. That is due to the increase in value of the original investment which they had, which has been held at historical cost. Lastly is the underlying PATMI. So you can see underlying PATMI has grown 7.4% year on year. This is after excluding all the one-offs. So they declared 11 cents final dividend, which is 1 cent higher than last year's 10 cents. And overall, for the full year, they declared 17 cents, which is 2 cents higher than last year's 15 cents. Okay, just to touch a bit on 4Q. So 4Q margin and profit was dragged down. It overall dragged down the full year results. It was poorer than the first 9 months. So in 4Q, the results was poorer due to two big main expenses which were higher, which is the staff cost and the company premises expenses. For the company premises expenses, these higher expenses came about because the rebate that Changi Airport Group has been giving was not renewed. So that rebate is off already. Okay, I've explained this last bullet point, so we'll move on to SIA Engineering. SIA Engineering also we have a neutral rating, target price 370. We're also forecasting 18 cents dividend for the full year. Sorry, 13 cents dividend. This also will be about 3.3% yield based on last close price of 396. Revenue was marginally lower at 0.8% year on year due to lower fleet management, but this was mitigated by higher line maintenance revenue. So what is going on for line maintenance as with previous quarters is that because of the new aircraft that are not requiring so much heavy maintenance, so more of their work is being done on the apron, and so revenue is accrued at the line maintenance business segment instead of the overhaul and repair business segment. Reported EBIT was 31% lower year on year due to one-off provision, but if you adjust that out, EBIT is actually 10.6% lower year on year. Associates associates and JV 2.4% higher year on year. There was higher work content at Eagle Services. Eagle Services is the associate company that services the Pratt & Whitney engines, and there was lower work content at SESO. SESO is the joint venture which services the Rolls-Royce engines. So all in all, on an adjusted PATMI basis, the PATMI was flat year on year after you exclude all the one-offs and non-recurring items. SIEC proposed a 9 cents final dividend, which is higher than last year's 8 cents, and a positive surprise came from a 5 cent special dividend, which last year there was no special dividend. So core EBIT was still dragged down by high labor costs, which was a 6.1% higher year on year. For line maintenance, the revenue was higher by 11.5% due to two factors. That's the organic growth and restructuring. So for restructuring part, I've explained earlier about how less revenue is being booked under the repair and overhaul heavy maintenance segment, and now is more revenue being booked in line maintenance. So that's the restructuring part. As for organic growth, there are 2 points here. SIEC actually handled 2.6% more flight year on year. This compares against the 3.2% growth in flights handled by Changi Airport as a whole. And also they did 14.4% more A checks due to larger A350 and B787 fleet. There was a positive surprise from the Pratt & Whitney associated engine shop, that's Eagle Services, but this is not sustainable. Why there was a higher share of profit from this associate is because of the airlines, because of the lower fuel prices had prompted the airlines to extend their end of cycle for their legacy B747 fleet. So the Pratt & Whitney 4000 engine is the one that goes on the B747, and management has said in the past and reiterated again that this PW4000 is a mature market and which will eventually be phased out. So this positive higher share of profits from this associate is actually not sustainable in the long run. Okay, we come to the end of the webinar presentation. We'll pause now for questions.
Hi, morning guys, De Hong here again. We have a question on CRT and that is that the CRT's latest gearing is 45%. Is that an issue? So firstly, Croesus is a business trust. They are not a REIT, so they are not subject to MAS's 45% debt ceiling. So that's one. And number two, because I think even though the gearing may appear high at current moment, the macro environment in Japan is such that the interest rates are falling over there. And then as evident from the kind of refinancing that CRT done this year, they actually achieved even lower interest cost than the previous time when they first took up the debt. So this is reflective of the falling interest rates in Japan. So in view of such an environment, I think it is good that you are using this kind of low interest rate environment to achieve a good spread on your yield that you're getting from your properties. So I don't think the 45% gearing is an issue as of now.
Hi, this is Richard speaking. There's a question. It says SIA is in some trouble. Will SIA get less business from SIA? I think that's quite unlikely because no matter what, SIA EC is a subsidiary of SIA, and so in all likelihood, uh, most of SIA's job will still go through SIA EC.
Hi, this is Paul here. We have a question on in today's market, which sector is the strongest sector, and in that sector, which is the strongest stock? In terms of just a broad brush, some sectors, as you know, we do not cover. But I think the strongest sector is, in terms of earnings, has obviously been the electronic sector. But we don't have coverage on this. But in terms of, as per our monthly report, the sector which has the highest momentum right now is property, and the other sector which we have buy calls with some of the property trusts, such as Croesus and APTV. Thanks.
Hi, it's Guanzi here. There is a question asking what's our view on the management of CNMC. Actually, we don't have any views. We don't comment on the management. And there is another question asking about whether the improving recovery rate from the future capex is trustworthy. And we think that, to be honest, we should look at the third-party geologic report, which is the job report. And based on the data last year, they drew the drilling holes actually reduced compared to FY15 and FY14. And the result shows that actually the reserve and resources didn't drop so much, and actually the reserves and resources improve a bit, and the reduction of ore grade was in line with the free cash flow that CNMC extracted from the sales. So in terms of the recovery rate, we think that the management have already realized this issue, so that they from FY16 to FY17 they started to try to do some inorganic growth via M&A activities. So you can see that the recent acquisition of Kelgo as well as the last year's Pulai project, we think that that is the alternative to can structurally improve the profitability rather than just solely rely on the current so-called field. So moving forward, we still need to see whether the recovery rate can improve from the current peak. And one of the reference or benchmark recovery rate we can refer to is the cut-off grade. So you can see that the current ore grade is actually slightly above the cut-off grade. So we think that once the ore grade drop to the cut-off grade, we think that on the business level, CNMC might stop or may not continue the mining activities on so-called field. So we think that the next quarter there could be higher probability that the ore grade will continue to fall or status quo as the fourth and first quarter of this year.
Hi. If there's no further questions, we shall end our webinar for this week. Thank you for tuning in, and we wish to see you again next week. Thank you.